Hello everybody, I'm Ryan and I have 13 years of Forex trading experience, and I decided to do a video series on specific aspects of trading. And this one is the first one, and I wanted to cover risk and money management because I think that is the most important thing in trading. And these are some of my best techniques that I've learned over the last 13 years uh, and put into one video. So hopefully this will be helpful to you in developing or changing and fixing your current strategy. All right, so you can see right now I'm trading a $126,000 account and doing this for a Forex trading friend. And I have some trades that have gone into the market. You can see them, and all of these were profitable trades. And finding a risk in money management strategies is not an easy thing. And bear with me, I have a cheat sheet right here to help guide me in some of the points that I want to cover. So it's not easy to find a risk strategy or a money management strategy that's really solid. You can probably find a lot of things on YouTube that are free, some techniques, and you can also buy courses and products that include these risk management strategies. And the truth is that a lot of these strategies that you find online are overused, outdated, rehashed, all sorts of negative problems that are going on with it. So how I look at it is the blind leading the blind. You have a trader that finds uh, or that invents a certain technique, and this trader, a money management technique, and this trader invented this 10 years ago. Now this trader puts it online and it gets circulated over and over and over again. And traders find this money management technique and use it in thinking that it's a profitable technique when it's outdated, maybe not even viable in the market anymore. And they keep circulating over and over again through the years and years. And so it lets people to believe that these are the right techniques that people need to be using in order to profit in the market. And this couldn't be more wrong. uh, this information that's being used over and over again is so old and in most cases not even profitable. Why is it not profitable? Because we know as traders in the retail trading space that 95% of traders lose their money, either all of their account or they have never made any profit since they started trading. So why would you use something that's old and that you found online or was used by some other trader that's supposedly was profitable? Why would you use this stuff, especially knowing that 95% of these people are losers? If you buy a product online, they'll say something like 95% win rate or 90% win rate in the Forex market, and it's just a bunch of crap, pretty much. They're just trying to sell you a product. They make more money off of selling you the actual product than using it themselves. And that's a big disappointment. I know that I charge for my service, and it's because I want to limit how many people I have copying my trades. And I don't want to be overwhelmed, and I want to spend the same amount of time with each of these individuals that do decide to copy my trades. And it's important that I spend that time and make an effort for those few that decide to do that. But risk is something that I knew was flawed because I wasn't a successful trader. This was back 9 years ago. And so I started realizing I need to basically try to reinvent the wheel here. If what I'm using isn't working and isn't working because it's purchased or it's rehashed information from a losing trader that says he or she is profitable, of course they're lying. And I use this information thinking that I have a profitable chance as well. Unfortunately, that's not the case. So back 4 years ago, I decided to try to invent my own indicators and strategies and risk management to try to see if I could figure out why those 95% of people were losing in trading. And if they're losing, why not try doing something complete complete opposite? So if they're losing, then do the opposite of what they're doing, and hopefully that will give me a profitable edge. And to my surprise, it was the start in the beginning of me becoming a profitable trader. And it's because I was thinking outside the box and wanting to do something different. So 4 years ago began my trading strategy having to do with counter trend trading. I found that counter trend trading was a more there's more profit to be had for me in counter trend trading than in trend trading. And again, that goes against what 95 what the majority of traders like to do. Most traders like to trend trade. And if most traders are trying to profit in trend trading, then of course I'm going to do the opposite, right? And I'm going to counter trend trade and have a better opportunity to profit. And so that's kind of how I do it. Um, and so that's why trading the opposite of what others are doing can be a very profitable technique. It's not that easy though. You mean, uh, it's emotions are tied into it. You have to have a good strategy behind it because not every counter trend trading strategy is a profitable one. You have to make sure that everything aligns. You have to have good risk management. You have to have good entries on your trades. You have to know how to compound correctly. You have to know how much balance you need to start with in order to be safe. What kind of news does your strategy need to avoid or not trade? What kind of news doesn't need to trade? All those kinds of things, because there's a lot of different facets that are included into a strategy. So let's move on to the next. Excessive use of martingale strategies. Now this is something that is used quite a bit. Now everybody always tries to accuse me of having a martingale strategy, which is so ridiculous because a martingale strategy is if you're risking $5 on a trade, you're in the next and you lose that trade. So you're gonna double your bet on the next trade. So $10 and then double that 20. And you just like at the casino, basically. And that's a martingale strategy. You can also use a semi-martingale strategy, which is 5, 15, 10, 15, 20, and so on and so forth. But this is a much better technique for when martingale, the word martingale is used. Typically that's used as a bad word and for good reason, because most martingale strategies don't work over the long term because they can really get out of control, like I was going with that sequence, 5, 10, 20, 40, 80, it just keeps going and going until you're out of money. So that's why that strategy can be so dangerous. But if it's used in a correct way, a martingale strategy does have a chance of survival if it's used at a very, very low risk with a somewhat larger account. But the problem is that I see a ton of them out there right now, and I just don't think that a lot of them were tested enough to really show promising results over years and years of time. Okay, so risk management is typically not tested enough. And to test risk management, it's not easy. A lot of traders don't even know how to do it. They don't know how to properly test their strategies because they're told that a certain strategy should work, and so they don't really need to test it on their own. And this goes for the newcomers as well. If they buy a course or take a course or buy a product, they're told that a certain type of money management or strategy is supposed to work, and so they don't need to do that testing. That it can't be You can't be more wrong about that. You got to do your own due diligence and research on whatever that you're using to make sure that it's working. Now there's a couple of techniques and ways to do this. One of them is buying a piece of software called Trader Agent. And I know that's it's a product in itself, but it helps with your trading. Not only can it uh, help automate parts of your manual trading by putting it, you can execute a trade, and this piece of software will help manage that trade for you by adding extra positions or taking profit and taking stop losses, so you don't have to constantly be sitting in front of your computer all the time. So pretty cool trading strategy. It only works with MT4 and MT5 as well, but make sure that you have a broker that does that. I'm not going to put that in the description. Do your own research. Check that out if you'd like. You can also use this trader agent in back history. So you can actually test your strategy to see how it works over the longer term, which is pretty cool. And it will show you all of your profit stats in that test, which is a really pretty cool piece of software I recommend checking out. So a way to test your manual strategies is through a piece of software. Unfortunately, it does cost $100, so I only recommend if you're serious about your trading, it might be something to look into. All right, so there are other ways to do this to test your strategy. So, for example, my strategy is called the. I've got a bunch of expert advisors in here. RMI Inside Candle version 3 license 320. Yeah, I know it's ridiculously long, but that's what my expert advisor is called. What is an expert advisor? It's basically, or short for EA, it is basically an algorithm. So it's a block of code that is able to trade the market through MetaTrader software through a brokerage. And so it puts in your orders and it executes your trades. It does everything on complete autopilot. So really cool. But the reason why I did an expert advisor was not to try to find a strategy that I could automate, and so I didn't have to sit in front of my computer and go on vacation and have this make money for me. The reason why I developed and started looking into expert advisors 4 years ago was to help test my strategies. Because I don't believe that the trader agent software was available 4 years ago to test manual strategies. So I decided to try to put my strategies into an expert advisor, an algorithm, to see if I could see how it worked over the previous data. And what's the benefit of that? What's the benefit of trying to find a strategy that actually has worked in the past? Well, the benefit is that you can see how the technique works, for one, and if it's profitable, and you can see how profitable it is as well, and where the wins and losses are. And if where those losses actually happened, maybe you can make changes or modifications to minimize those losses by changing the code or how the trades are entered and exited. And so this helped me try to develop a strategy that worked very well. And it does matter if the strategy has worked 5 years, 10 years, 20 years. And why is that important? Because the longer a strategy works in the past, the better chance it has to survive in the future. And it's because a trading pair, like the pound Canadian dollar, has a personality. Yes, that personality is changing, like I mentioned already, on a daily basis, but it may be changing within reason of what happened in 2013. So a small snippet of what happened previously. So its behavior in its time frame is changing, but is it changing within means of what has happened in the last 10 years? So this is what I'm going for, is trying to read a personality of a pair, and the longer I can read this personality of a pair, the more I can hope to understand it in the future. And so this is what my strategy was based upon, was finding out that one, a currency pair does have a personality. And the more I can understand that, the better off I'm going to be in trading it in the future, which is the unknown. I don't know what's going to happen in the future. And so my best shot of understanding the future is to understand the past. We obviously know that the past isn't going to repeat itself exactly. But if it can repeat itself, or not repeat itself, but if it can change within reason of previous data, then maybe I have a chance to really continue to have a profitable strategy. Now, this test that you see here was something that I've been testing for my current followers, which I have about 60 right now that are copying my trades, is a $600 starting balance. So $600 turning into, this is ridiculous, I know, and turning into 25 million. Yeah, that's stupid. And I'm not like thinking I have the holy grail system here. You can see the one loss here, and there's also one loss in here. But it's not about $600 turning into 25 million, because as you can see in this test, very crude method based on the nearest less time frame results must not be considered. Now, I'm not going to tell you guys that this is a real $600 turning into 25 million in 8 years, or I think it was about 11 years, because that wouldn't be telling the truth. This kind of strategy, or this test that I ran here, is a more crude way of testing. You can't believe these results. What you can believe is the losses that happened. Loss here, loss that happened here. That's what I'm looking at, are these specific areas. I want to see where my strategy lost in the past, where it couldn't keep up with the money management or the risk. That's what I'm looking for, not the actual profit gain, although that's obviously has some importance. But I know that this kind of test, in this particular test, that number is not beneficial to me because it's not very accurate. There are other tests that I can run to give me a more accurate number, but this test is just showing if $600 is able to is able to not crash and burn, basically get a margin call where I lose the entire account, and that never happened in those 11 years. So that is a way to test your strategy, is having it created through an expert advisor, and you can do that by going to mql5.com. mql5.com allows you to hire a programmer. You don't need to know code yourself. Hire a programmer with your strategy, and you basically say, I want my strategy to do this, I want my strategy to do that, and the programmer should be able to help you put it into a algorithm that you can install onto your software and test it just the way I do. Alright, so next, I don't want this video to be too long. I'm already going 17 minutes. Grid trading. So I'm going to cover a few more aspects. Grid trading is usually looked at as poor money management. And you might be wondering, this is a grid trading system that I have here. Grid trading means that I have one trade that goes in, 2, 3, 4, 5, 6. I have multiple trades, and they are the same distance apart. So let me remove the bit here. So they're the same distance apart. So trade 1 is the same distance from trade 2, is the same distance from trade 3, 4, 5, and 6, and 7. So that's grid trading. And basket trading is when I have all of these trades in, 7 trades in, at the same time, and they all close out at the same time. So that's basket trading. So grid trading and basket trading are different, but they can be used at the same time. And the reason why grid trading is considered a bad thing is because it's usually incorporated with martingale techniques. So trade 1, risking $5, trade 2, risking $10, trade 3, risking 20. That's a lot of times how grid techniques are used, which is not a good technique in most cases. For me, I'm using $5 risk, 5 on this one, 5 on all of them. It's the same risk on each trade, which is actually quite low. I'm not saying I'm risking $5 on each trade. That's just an example in this case. All right. So that's how I use grid trading, and unfortunately, it gets a bad rep out there because of people misusing it. It doesn't have to be used in a martingale or technique in order to be useful. Why adding to losing trades can be a good thing if it's done within reason. So it has to be done within reason. If you're adding to a losing position, so trade 1 and trade 2, so once trade 2 is entered, that means that I have already added to our losing trade 1, right? So trade 3, we're adding again, trade 4, trade 5, and all these are buy trades, by the way. So these are buy And we want this market or the price to move up. We want it to go up. And it did eventually, and that's why we came out with profit. So we're adding to losing trades. And why is that? Why can that be beneficial to our strategy? Well, adding to losing trades also has a bad, uh, it's like a bad word in the trading world, and or in the standard world of understanding when it comes to trading, because people think, oh, that means that you're just making a bad trade worse. Well, technically you are for a little bit. This trade went from just one single trade to two to three to four, and the drawdown from trade one continues to get worse as this go down. Same with trade two and three as it continues to go down. All you start having a larger floating loss. But eventually, in this case, trade seven did move up, and we were able to close out all trades. And some were in loss. These three were in loss, while these four were in profit. So that's how I was able to come out with a grid and basket and a adding to my losing trades. All the negative words that people and traders typically find uh, that I do work in this case. And I continue to prove people wrong that these techniques can't be used. So adding to losing positions have to be done within reason. The reason why the reason for that is because you can't just keep adding and adding and adding until you just don't have any more margin or account or money left. You have to make sure that you have to have some kind of stop, some kind of plan, just in case the market continues to go against you. You can't just keep adding forever. So there comes a time where you have to make a decision, or your expert advisor or your algorithm needs to have a cutoff where you actually take a loss. And that's what happened in the strategy here. I took a loss. I took a loss. This one wasn't a loss. This was very close to one, but it wasn't quite. And so my algorithm knows when to take losses when things get too out of hand. And we need to accept a loss and move on to better opportunities so we can potentially make that profit back within, 1 to 3 months. Okay, so I know that sounds like a long time, but that's actually very short in the investment world. Making a loss back, a potential loss of 15 to 20% back in 1 to 2 months, or 1 to 3 months, that's pretty unheard of. So just keep that in mind. All right, so next, and before I end this video, uh, so yeah, my last point was testing your strategy so it works over years of time. Why is this important? Well, I think I've already explained that to you for the most part. The longer that your strategy can run in the previous history, the better off you're going to be for the future. Because if it runs for 10 years, you can see what happened to your strategy. Why was it profitable? Why did it have losses? Are there ways to modify your strategy so it doesn't have losses during that time? And you always have to, there's always a potential to run into uh, what's the word I'm looking for? Uh, where I can't think of the word right now, but it's basically when you modify your strategy to fit previous history perfectly. And there's a word for that, but I can't think of it. Anyways, it's when, oh, here it is. Got it. It's over optimizing your strategy. So you optimize it so it fits previous history perfectly, and a lot of people and a lot of traders will find that to be something negative. But I look at it in a different way. I basically look at my strategy, look at its worst times that it's had in a 10 or 11 year history, and base my strategy off the worst possible times. So let's say that this was its worst possible time back in, I think it was 2014, where it had the largest losing trade. I'm going to base my strategy off of that losing trade just in case that kind of price action or movement, price movement happens again. And so I'm going to make sure that if that happens and even goes deeper, if it goes worse than that, I'm still protected. So I'm not going to over optimize too much. I'm going to try to give my strategy some uh, adaptable measure, some uh, a way to, so it's not just in this cookie cutter type of test where it needs to do this, it needs to do that. It has to have some kind of adaptation over a longer period of time. And this is why I have my strategy based on this worst point. And this is why my risk is the way it is with my strategy. If my risk is too high, 2014, I'm going to lose my entire account. If my risk is too low, well, then my strategy is going to be good, but I'm still going to have a loss here. It's just going to be smaller. So what's a good balance? I have to figure that out. And my strategy needs to be able to uh, fit into a large period of time with some leeway. I guess that's what I'm going for. I don't know. Maybe I'm struggling to talk right now, which is probably the case, meaning I should probably end this video. But I think there is one more thing that I wanted to cover in this video. It's for my users that are having my trades copied in currently. So the 60 people that are copying my trades right now. For those that are copying my trades, I'm looking into a new strategy, for one. Very nice so far. And this one takes a lot more trades than the one that we're currently doing. And it's looking pretty good. I still have a lot more testing to do on it before I release it to everybody and give it as an option. All right, so settings. We need to go over settings of the trade software that I'm using. So those of you that are just tuning in to this as people that are not copying my trades, this is a piece of software that I use to have my trades copied to individuals that want to have my trades on their account. And I have them install this piece of software, and they set it up. And I was able to get 60 people during a promotional period on my website. All right, so for those of you that are using this software, so you can see the set lot size, provider risk scaling, and you want that to be set to provider risk scaling, and this setting here. So scale factor, that means that you're copying my trades one to one, right? And so whatever I'm taking on my this $1,000 account, you're going to be also getting it on your $1,000 account. And going back to my test here, I want to make sure that you guys are not over risking your account. What happened in 2014, if it happens again, and you're risking more than what I am recommending, there's potential that the strategy might blow up on your account and you may lose more than just 25 or 50%. Risk has to be controlled. And that's why I don't trust anybody to purchase my algorithm or expert advisor, because I don't want them to misuse it. So the most risk that I recommend you going is 1.7 or 8. So that means that you change this to probably 1.8%, and you go from there. If you move higher than that, it's just going to things could get out of hand. Even increasing the risk more than my scale factor of 1 to 1 means that you're pushing the strategy more than I recommend. Yes, there is room for it to be pushed more. I'm conservative. I want my account to last a very long time. 1.8% could, or it's on the scale factor, means that you're almost doubling my risk. So if I'm making 8 to 12% per month right now, then you'll be attempting to make around 15 to 20, 24%, 25%. And that is a big number. But when you try to make more money, you also risk potentially more money as well. And if some people have been wondering about upgrading their margin. So currently I have a 500 to 1 margin account, and that's what I'm recommending to everybody. And some are thinking that if we can upgrade our margin to 1 to 1,000, that means that we can risk the same but make double the money. That's not how that works. It means basically increasing your margin means that you can lose your money a lot faster. So I do not recommend doing that. So scale factor, no more than 1.8% until you hear from me. And even at that level, realize that I can't help you if you have losses. I mean, I can't even help you if you have losses that at 1. Because, guys, this is a copier. And if I'm having a loss, you're going to have a loss as well. But you have the choice to not use my trade copier or to use it. And all you have to do is just press that button to turn it off and on. And I don't want to be your financial advisor. All I'm doing is giving you the opportunity to do what I'm doing. And to do it in a less risky way than trading in the crypto markets, trading in the stock market, and trading many other places. And I want you to understand the reasoning of why I use the risk I do. Because I want to make sure that I'm not I'm covered over a long period of time instead of trying to make a bunch of money in a month or two. Because in almost all cases that goes poorly. All right, so if you guys have any questions, let me know. And I think I'm going to end this video at 30 minutes. And hopefully I can do another one that's not as long in another area of trading. So hopefully you can look for that in the next couple of days. Thanks for watching. Bye.